Hi, my name is Jordan Wilson. Today we're going to take a look at investment risk. So today's objectives are, first, to compare investing versus gambling. Both are speculative risks, but the outcomes are much different. We'll take a look at how investment risk is not a fixed concept. It differs between individuals based on your experiences, your financial situation, your personality. We'll take a look at how you specifically view investment risk. And we'll cover the different factors that may or may not impact where you lie on the spectrum of investment risk. Finally, we'll take a look at how I probably view investment risk, objectively, with a minimization of emotion and outside influences, just the pure financial analyst calculations. So, in our prior discussions on risk, I said that investment risk is a speculative risk. Like pure risks, there is the possibility of loss or no change in status. But there's a third possibility, the possibility of gain. And that gain may be a 10% return on a bond. In that case, you expected a return. But there's also the unexpected. Maybe you invest in a stock and hope to get 20% return, and instead you get 50%. That is also part of the gain portion of speculative risk. We talked about how gambling is also a speculative risk. And there are some people who equate investing with gambling. But I think there's a few important distinctions. So yes, both investors and gamblers can become better in their craft. You can study effective gambling strategies. You can avoid alcohol, emotional mood swings, and sleep deprivation when you're in Vegas. Maybe only play games with the best probability of success. Similar with investors, you can educate yourself, become more experienced, take a disciplined approach to investing, and maybe here too, you only invest in assets with quote unquote the best odds. A bigger difference is what I would call the potential certainty of returns. So if I go to Vegas and I walk in the door with $1,000, I have no idea what I will leave with at the end of the night. Maybe I get lucky, win $1 million. Maybe I break even. Or for many people, you go home at the end of the night with nothing in your jeans. That's a little different than investing. I can invest in a 1-year government bond that's going to yield 10%. I'm pretty much certain, unless the US or Canadian governments collapse, that I will get my principal back with the 10% return. Much different than going into a casino. So that's probably the big difference. Let's look a bit at how investment risk differs between individuals. On one end of the risk spectrum, you have, let's call them the widows and orphans. Not the ones with the huge trust funds, but the ones from the world of Charles Dickens. They have little wealth, poor cash flow, not much in the way of prospects for the future. To them, investment risk is anything that could impair their capital. They're happy to forego returns in exchange for safety and income. Things like guaranteed investment certificates, treasury bills, safe, secure, with relatively low returns is what they want. At the other end of the spectrum, you have the wolves of Wall Street. They talk in big language that no one can understand: alpha, beta, CAPM, variability of returns. They're much more risk tolerant, and they take a big picture of risk, partly because they understand how the relationship between risk and return works, and they understand the techniques to optimize that. Somewhere along that spectrum is probably where you sit. Maybe not down with the widows and orphans, but probably not up with the Wall Street wolves either. Your past history impacts where you sit, your emotion, your personality, your personal financial circumstances. And I think where the average investor tends to fall in the spectrum is more of an accident than an intention. So everything happens and you end up 3/4 of the way towards the wolves of Wall Street, or 3/4 of the way towards the widows and orphans. But it wasn't a planned process. It was just, we'll stir everything together and that's where we come out. So the objective here would be, it doesn't matter so much if you are a widow or you're a Wall Street person, but taking a more systematic approach, understanding where you want to be and where you should be on the investment risk spectrum will help you create better investment portfolios and ultimately achieve better results. So your view of risk. I think there's a few things that factor into most people. One, there's a fear of losing capital. We talked about that with the widows and orphans. Now that may be absolute dollars versus your initial investment. So you put up $10,000 and anything under $10,000 is a loss. That may be true, but it also doesn't factor into things such as opportunity cost. What could I have spent that $10,000 on and got a better return than zero? It doesn't impact the time value of money. So if I take that $10,000, break even on it, I've actually lost because I could have put that into a term deposit for 1 year and got 3 or 4%. It also doesn't factor in things like inflation and purchasing power. So if inflation is 3%, my $10,000 investment has to earn a minimum of 3% just to stay even with the cost of living, with purchasing power. So there's things within losing capital that you need to consider a little bit more. There's also realized versus unrealized. To some people, losing capital is only lost when it's out of your genes. So that $10,000 I invest, maybe it's up 2,000 and I'm happy. Maybe it's down 2,000, I'm unhappy. But until I actually sell and realize the profit or loss, then it's not in my genes yet. So for some people, they're not too excited about losses until they actually sell. Other people, it's when it's unrealized losses that they have concerns. What you also find is the concept of loss aversion, which is a behavioral finance concept. And what you tend to find is that investors have about a 2.5 times, let's call it preference, to a loss over a gain. So if I had a gain of $2,000, I may be happy with it, but I'm 2.5 times more unhappy if I lost $2,000. So again, when we look at speculative or investment risk, It's the risk on both sides, the gain and the loss. And by having a higher risk aversion to the loss, that can lead to suboptimal decision making. Second, historical. Past experience extrapolates into the future. But what we see in every mutual fund prospectus out there is some form of past performance is no guarantee of future results. So just because something happened in the past doesn't mean that it's going to happen the same today. You could have a company that had new management. Maybe it was a good company, the managers left, and now it's going to be a poor company. Maybe it's a poorly run company that hires new management, and it's going to be a good company. So past experience doesn't guarantee the way things will be in the future. And I see this a lot with people that were burned on a specific investment. So you bought gold 10 years ago, you lost money on the investment. Now you're very leery about getting back into gold as a future investment. But you need to look at things from a future perspective, not, oh, I was successful last time with this investment, or I was unsuccessful with this investment last time, and that's going to dictate your future course. I think everything has to be sort of forward-looking. Another thing that impacts people's view of risks is the follow the crowd. It's tough to swim against the tide. It's easy to listen to the conventional wisdom, the talking heads on BNN and CNBC telling you what to do. That sort of confirmation bias or herd bias. So it confirms your own thoughts. Maybe it's right, maybe it's wrong. But that's what a lot of people operate on is, oh, this is what Jim Cramer said, so he knows what he's doing, it's got to be right. Often it's not. I also think that by following the crowd, you don't feel as bad when you lose. So Jim Cramer tells you to buy Google. A year later, it's down 20%. Yeah, you feel bad because of the loss, but you feel less bad because you know that everyone else is in the same boat as you. Whereas if everyone was saying, all the talking heads, don't buy oil and gas stocks, you go out buy oil and gas stocks and you lose 20%, you probably feel a little bit less happy with your decision making because you were warned by the professionals, by the experts. So that's another area. And finally, lack of familiarity is a big fear for people. There's a connection or a correlation between your unfamiliarity with something and its complexity. So if you don't know the technique or you don't know the situation, it may seem to be more complex and therefore risky than if you know what you're doing going in. So that's also an issue. I use an example here of covered call options. Covered call options can be a very low risk hedging exercise for investors. But because there's something that most investors don't use on a daily basis, they don't understand, they view covered call strategies as potentially higher risk than things that they're comfortable with. So a covered call option strategy may be very useful for the widow and orphan, but there's a very high probability that they will not be interested in that. So what exactly is investment risk? Well, on a definitional basis, it's really just the probability that the actual return will be different from the expected return. And as I've said before, that's on both sides. So you might have a higher gain than you expected, not just a loss or lower. It also reflects the level of risk. The greater the probability the returns will differ from what you expected, the higher the risk. And that's where the Wall Street Wolves will talk about variability of returns. And what I mean by this, in a simple example, is let's consider some risk-free treasury bills. And at the moment, they are considered risk-free in places like Canada, the United States, but that's subject to change in the future. Who knows? So we have a T-bill that's about $976. 5% yield, 6 months, you're going to get $1,000. That's going to be 100% certain. No risk. Widows and orphans love this. Or Jim Cramer and his friends say that ABC stock will be worth $11 in 6 months' time. So if you buy that instead of invest in the T-bills, you'll end up with $1,100 as opposed to the $1,000. That would be a step up, so probably a better investment to make. But because it's a risky asset, common shares would be risky. In 6 months' time, what are the odds that it will really be $11? For those of you who have invested in the past or are investing now, you'd probably agree that for a typical common stock, 6 months out, or even a year out, 2 years, it's very hard to predict with any accuracy what the price will be. So it probably won't be 11. The farther that it is from that 11, the greater the investment risk. So investing has taught us that the $11 in 6 months is probably unlikely. But just how much is it unlikely? In 6 months, what is the probability ABC? Is it 11 or 15 or 8? And that sort of is the problem with analyzing investments and investment risk. It's a lot of apples to oranges. How can I compare a risk-free treasury bill to ABC common shares from a risk perspective? Or how do I compare ABC to other companies in other industries? Amazon versus, say, Mitsubishi in Japan, or Zurich Re on the Swiss exchange. Different countries, different industries, different companies. How do I compare them from a risk perspective? So we need to turn apples to oranges into apples to apples and figure out a way to quantify investment risk across the different companies and different asset classes. And to do that, investors use variance and standard deviation. And there's also things like risk-return ratios, Sharpe ratios, Trainer, Sortino. So next time, we'll take a look at how standard deviation is a good way to approximate and compare investment risk between different investments and different asset classes. So thank you for your time today, and we'll talk to you next time.